Crypto markets rip higher alongside gold as Bitcoin makes a new high around 126k. The US government shutdown and talk of stimulus checks funded by tariffs put the debasement trade back in the spotlight. Crypto volatility, though, barely reacts, as this move is not fueled by fast money speculation. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my co-host Dave from FRNT, and today's special guest is Oleksandr Proskurin, co-founder at Arkis. How you doing, man?
Yeah, doing well. Nice to be here.
Thanks for coming on the show.
Good to have you on, man. Really good to have you on.
All right, so the bulls are happy.
Welcome to October.
October. Oh yeah, it certainly delivered, didn't it? My gosh.
Yeah, it did deliver. I think it delivered like ahead of. I thought we'd get into as we came into October. You know, the kind of liquidity hangover from quarter end, but it kind of felt like markets. I don't know if markets kind of front run it or. Obviously, we had the trigger of the government shutdown in the US, and I think again that actually, I mean, I speak a lot on here around, Bitcoin covering both the left and right tower of the risk distribution. Obviously, on the one hand, it's just the ultimate high beta, sort of trade when risk is pumping, but also on the sort of far left of the distribution, it's the ultimate hedge against the failure of existing sort of economic and political structures. And when you see the US government shutting down, it just kind of goes to highlight the reliability, predictability of a Bitcoin network that's decentralized, non-sovereign.
The thing is that the market's not overly concerned about the shutdown because equities are rallying as well, right? It's not a risk negative event, even though you might think it would be. It's not anymore. And historically, government shutdowns have never really been negative for risk, right?
No, exactly. And I kind of think it just feeds my thesis, if you like, around the fact that we're more a function of rates and liquidity and what that's doing, rather than some of these more sort of fundamental,
but
things.
Stimulus checks.
But yeah, but this is
all-time highs.
Yeah, I mean, yeah, it's this sort of move towards this like fiscal dominance stories is just big, and now everyone's catching on. Even the JP Morgans of the world are kind of talking about this debasement trade. But there's been this kind of implicit acceptance of higher inflation, and this need that for growth. We need ever more debt, and we need the stimulus checks. And I think Trump said that we need to grow our way out. And that's always the kind of default, right? We're going to, and essentially for me, that's him saying we're going to run this thing hot.
Yeah, for sure.
And if stimulus checks come as well, I mean, that's just going to add to that. And then in the meantime, because then, I mean, you're seeing bond markets come under pressure a bit again, which for me is if there's one little concern at the moment, it's still that.
But they're not really doing it in any high vol though. They're grinding lower, right? I mean, Japan overnight over the weekend had a bit of a move. Anything to be worried about there?
Again, right? They've just elected a sort of new PM that's coming in with promise of more candy and fiscal spending. She's going to pressure the BOJ to probably not hike rates. So now all of a sudden you've got the sort of the JGB, Japanese government bond market under pressure.
So if they don't hike rates in the front, then the back goes steep, basically.
But it's the market again starting to lose confidence in bond markets, and ultimately what will happen is that they will come in and I mean the BOJ have all said that already. That they will
buy bonds,
step in, to
how are they going to buy bonds?
Volatility.
Print more money.
Print more money, exactly.
Yeah. So I don't. I'm kind of worried, like kind of concerned about the bond markets, because look, there's a clear, you think this 60-40 portfolio. There's a clear, I mean, the 40, the bond side has massively underperformed, not just in terms of nominal terms in the bonds, but also the fact that, you're in fiat currencies that are getting debased. So when you own local currency bonds, that the actual currency is becoming worth less. So I think you're starting to see, obviously, and you're seeing it really, in gold and this kind of pivot towards other hard assets and out of this traditional 60-40 allocation, and then looking for the hard assets. And all of a sudden, we've been talking about it for, since we've been doing this podcast, the debasement trade. It's now becoming a very fashionable thing to talk about.
I mean,
but it's happening.
The gold chart is absolutely parabolic. Like, if you look at the monthly chart on gold, the RSI is in the 90s.
Yeah.
Right? It wasn't there. Last time it was there was in the 70s.
Yeah.
Right. I mean, this is unprecedented move in gold. Right?
I think this is probably the best, like one of the best performing assets, even like compared to like Bitcoin.
Yeah, and vol adjusted, especially.
Yeah.
Right?
What I think is just really interesting is, say, at the core of my thesis and like bullish thesis for Bitcoin and is the debasement trade and the fact that I don't see how we escape this need for perpetual sort of deficits, ever growing sort of debt. And then the need to financially repress those markets to keep yields sort of down. Now, that's been going on, but it's been going on at a slow enough pace that no one kind of really noticed it, right? And NASDAQ and S&P kind of goes up, you 11% or whatever every year, and but it's all been slow enough without anyone noticing. I think now, whether it's just because of technology and we've got access to greater information sort of more quickly, whether it's the move in gold that's really standing out, gold that kind of didn't do a lot for a lot of years.
Yeah, but it's catching a lot of headlines.
Catching a lot of headlines. I think people are kind of
people scratching their head, going, "Why?"
Yeah, right. and they're seeing the impacts of debasement more real time. Now, the question is do major governments and central banks manage to maintain sufficient confidence and market credibility that we don't see a complete exodus? And I've said, I kind of use the term that, do we get this beautiful debasement, which to kind of paraphrase Dalio, but like where it kind of just happens slowly and that's the Bitcoin at $1 million in 5 years type story, or is it, or does something actually break and we get this, complete loss of confidence, bond markets under speculative attack, central banks having to come in and print to basically perform some sort of yield curve control, and then currencies get absolutely annihilated.
And gold goes to 10,000.
Gold goes to, and Bitcoin's like, at $1 million, in a blink sort of thing. I don't think we're there, but it feels.
If it happens like that, I don't think we're going to be feeling as good, right?
Yeah. So look, there's clearly a lot of those dynamics are really kind of coming to a head. Seasonally strong in Q4 in a way, and we've got off to a good start. Other than the bond market and potential volatility there, which would be led by Japan, I
just got to let this run. Right?
I think you got to let it run.
Yeah.
And, there's still actually no real signs of.
I do. I mean, you've been sticking to your guns. All year. And you so far have been proven well and truly right. So respect, props for that. But why don't we move on now and talk a bit about Arkis. And why don't you first tell us how you got into the industry?
Yeah, actually, initially I was in traditional finance space. So I was working as a buy-side quant. Actually, initially I was trading index options on the S&P 500. So initially from a volatility trading space. At some point I moved to a prop trading firm which was doing algorithmic trading, HFT and market making. I would say the great thing about working as in a prop trading firm that you're kind of exposed to almost any asset class where the volatility is high enough, where you can make money on. And we've been trading a bunch of stuff there, Forex, futures, options too. And eventually with my co-founder, Serhi, who is also from a traditional finance space, but more on a discretionary side, we kind of took a look at what brewing in DeFi space, and actually asked ourselves one question. So if a financial market matures, what are the the most important fundamental parts of a mature financial market from an asset management perspective? And we actually saw that prime brokers like Goldman Sachs, JP Morgan's, Morgan Stanley's, all of these investment banks are the building blocks and foundational blocks of any ecosystem. So if you try to predict what would have like a perfect product market fit in asset management industry, it is most probably prime brokerage and credit for institutions. So that's where the Arkis came from, initially as a DeFi prime broker. Now we have expanded into DeFi, CeFi. And
so explain to it a little bit for the viewers, like the difference between. So what makes you different to a CeFi, which means centralized finance prime broker? Like how do you differ?
Yeah, I would say we differ from a CeFi prime broker by the fact that we can collateralize on-chain positions, like staked positions on EVM chains, PandelPT positions, Uniswap, etc., and also provide portfolio margin on centralized exchanges, because most of the hedge funds, especially delta neutral ones, they always hedge the exposure. So, and they do this on centralized exchanges. And I would say that's our key way to differentiate, is by providing portfolio margin across DeFi and CeFi venues. By being a DMI prime broker on Deribit, Binance, Bybit, and OKX, at the same time being able to take on-chain assets as collateral.
Okay. And what puts you in sort of the unique position to be able to offer that as opposed to other people?
I would say that it is it was kind of a natural progression of ours. Like, we started as a DeFi prime broker, and we started to to cater ourselves and to compare ourselves to existing credit protocols. So on the one hand, we, as a prime broker, we actually work as a credit protocol, like Aave, Morphos, Eures, and of this world. But on the other hand, since day one, we started working with institutions only, because you actually see that even the TVL at these protocols is driven by institutions, not by retail clientele. And the institutions told us from day one, hey guys, we have this huge issue of inefficient capital, of using inefficient capital. I cannot collateralize any of my on-chain positions on existing CeFi prime brokers. So how do we try to converge these two worlds? And we just decided to build a solution for them, and this is our definitely unique value prop to our clients. But at some point, when you see they have built out the tech even to serve those clients who work on centralized exchanges only, because our margin engine is quite agnostic to whether it's DeFi or CeFi. It's just being able to understand how do we price an asset, and that's it, and how do we liquidate it.
And your client base is what? Primarily hedge funds? Yeah.
All of our clients base are regulated, market neutral, mostly hedge funds, who operate, of course, first of all on DeFi, but we see that there is a big chunk of unserved clientele, even in a CeFi world, who would like to get credit and use it on centralized exchanges.
How are you seeing in the institutional space? Like when a lot of these guys first come in, you've had obviously some big issues with centralized exchanges, certainly from a regulatory point of view, and just concerns around the safety of that. So then an obvious thing was to trade on CME or what have you, and express views that way. And then, as the regulatory landscape's kind of evolved a little bit more, and which has probably actually been helped by post FTX and different solutions around that, then it feels like there's comfort that's then grown with the centralized exchanges. The one thing that I've always felt with DeFi was, again, that's like a next step for these institutions in terms of getting comfortable with the risk, smart contract risk, all these things. Comfort with the KYC, AML type implications of trading on DeFi. How have you seen that evolve and institutions' approach to that?
Yeah, I would say that it's definitely, we have seen a huge leap in institutions being more comfortable with DeFi exposure. And I would say that how did we cater for it is that we actually act as a tool, meaning that if, for example, a whitelisted set of institutional lenders who know whom they face from the borrowing side, so I, as a regulated institution, really want to make sure that the credit which I provide will be only used by these 10 institutions whom I KYC'd and checked. and these institutional borrowers know that these are the liquidity providers for me, we are a perfect tool to actually, on the one hand, use the blockchain technology to power it, because the technology is very good. It gives lots of benefits. But on the other hand, we solve this issue of anonymous interaction, that you really know that those assets which you took from are definitely not from North Korean hackers or some assets which came from mixers. And it actually creates a regulatory framework for both lenders and borrowers to say, we actually work with with a clean funds which went through all of the possible KYC and AML checks, and the compliance department says, yeah, now we feel confident. Because what we've seen that the compliance and KYC process is also, on the one hand, it's kind of standardized, but it does have this emotional component to provide to this compliance department a framework to say, hey guys, you can be sure that everything is fine.
It's almost like
everyone
DeFi,
works.
but verified DeFi.
Exactly, verified DeFi. Exactly. So,
Okay.
and it actually kind of shifts the whole paradigm of thinking in terms of lending and borrowing. Because now when you design a protocol and interest rate model, you really know that the borrowing party is not a party which might have any sort of malicious intent. So on Aave or any other credit protocol, anyone can play around with it, try to find some exploits, or do some bad actor, actions to spike the interest rate. While here, you definitely know that you lend out to a known people whom you KYC'd, you know them personally, and it really creates a fundamental shift in terms of how you actually approach lending in DeFi and CeFi.
Interesting.
How do sort of lend and borrow rates sort of vary across from DeFi to CeFi? Is there a huge sort of differentiation?
Yeah, is there an incentive for people to go the DeFi route in terms of yields that they can get and stuff like that?
Yeah, I would say that it is the DeFi yields. I would say that if we take a look at the credit market in traditional finance space, you have different ways to allocate. You have private credit. You have government
high yield.
Exactly, high yield bonds. So, and any credit hedge fund, they do not allocate to something particular. They just allocate across different sectors and types of credit, because that's essentially what the regulator asks them to do. I think the DeFi is just another kind of degree of freedom for them to choose. So the DeFi yields are driven by demand for credit on-chain, funding rates, etc. So I think that in the future, credit funds would also deploy into DeFi products. It's at some point, DeFi yields will be higher compared to private credit. Sometimes it is lower. We have seen some huge issue this year with in February, April, when DeFi yields were even lower compared to traditional finance space. But I think that DeFi yields have become just one of the credit products where the credit funds will allocate.
And so they'll be pushed around by supply and demand, just like any market.
Exactly. So it's just a way to it is like a credit product which has a unique factors which influence it, and you can decide which one you want to choose. And with industry being become more and more mature, it is not guaranteed that DeFi yields would always be higher compared to TradFi yields.
So what is the incentive then? So because I'd say my knowledge in this whole space is pretty basic, right? So say the yield's not higher, what's going to incentivize me as an investor to go into the DeFi space then?
I would say that it's actually a very good question. We had actually the discussion today with Fasanara Digital and their new MF1 credit product, and it actually involves private credit. And on the one hand, this private credit portfolio generates quite good yield, but it is private credit, so you actually just need to believe in the track record of a credit fund that these funds which been provided to those entities won't get defaulted by unpaid loan. while on DeFi credit, most of the DeFi credit is actually collateralized. So collateralized credits are always something you would prefer because you have to actually have a liquid,
secured.
a secured collateral. Exactly. So like it is a secure prime lending.
Okay.
So when you estimate a credit, like there are like different like degrees of freedom and different factors you analyze, and yield is not the only one.
Okay, that's interesting. So when you describe it like that, arguably, if you trust that the DeFi is going to work the way it's meant to work, and you have a good understanding of that mechanism, then in terms of the actual risk of default, often because it's collateralized credit rather than unsecured lending, you're going to see lower yields. You're not going to see higher yields, right?
Yeah. This is actually
for a good reason.
Exactly. And this is actually what I expect. And this is the reason why, like Goldman Sachs and JP Morgan are actually positioned in a very good way when they lend out, because they lend out to those hedge funds they know about. It is all collateralized and being controlled. And those assets which are they provide credit to are being controlled by their internal walled garden. So you as a credit facility are exposed to a great set of borrowers, and you control the way to make sure that the loan is repaid, because you are the one to hold the collateral. So truly we do see that DeFi yields, I mean, depending on the supply demand, but the DeFi yields might be lower at some point in time compared to traditional finance yields, just because it just feels secure by the market.
And you mentioned JP and Goldman's and stuff. Like, what are you concerned about them coming into this space and taking market share? Like, is there like a barrier to entry for those sort of firms to do what you're doing?
I mean, it is a very good question. When we probably a year ago we've been asked about what would happen to you if CeFi prime brokers would enter the DeFi game.
Yeah.
But essentially, what happened is that we were not concerned by CeFi prime brokers entering the DeFi game. What we did, the DeFi prime broker decided to enter the CeFi game. So it is like the other way around. And I would say that, of course, the Goldman Sachs and JP Morgan would try to offer this kind of service. I can definitely say that we do plan to expand ourselves into traditional finance world. Of course, most probably will compete with them with their balance sheet, etc. But on the other hand, I can say that they internally are huge organizations which take way more time to execute something, because they have this huge, amount of regulatory things to be implemented and checked before they can do anything. And of course, the expertise is needed for them to span out. And
they need a lot of buy-in, basically.
Exactly.
From internal buy-in, basically.
And you can really see that even in centralized exchanges world, we cannot see JP Morgan or Goldman Sachs providing you credit on Binance, Bybit, or OKX. Crypto has their own set of prime brokers who expand themselves naturally. Like, these prime brokers start offering CME leverage, which we also aim to do in the nearest future. So we're not that much concerned of prime brokers and traditional prime brokers coming into the space. Yeah.
And then you mentioned regulation. So because clearly there's been a lot of the reason why crypto's rallying so much is all this institutional money's coming in, right? We saw record inflows last week of 6 billion across all assets. That's the highest weekly inflow we've ever seen, right? So clearly it's gaining momentum, and largely in part to all these various regulations like the Genius Act or whatever coming through. So from your vantage point, has the regulatory move impacted your business, the future of your business? What do you see there?
Definitely yes, because we can really see some of the institutions who used to say we can never ever touch DeFi due to regulatory reasons. We want to do that so much, but we cannot. And that's why I'm saying that compliance and KYC has this, like emotional component, because they always, like the compliance, they always try to hedge out themselves as much as possible. They always are willing not to take the risk rather than
But
take the
that's their
risk.
one job, to avoid like some disastrous blow up.
Exactly. And the thing is that the amount of comfort you need to provide to them should be way more than the the actual state of things, which is actually good, because like we need this sort of like a protection layer to protect us. But we really see that crypto is trying hard, and we see more and more of like creating more and more regulatory frameworks, and more and more institutional people coming into finance. So people from traditional finance who understand what kind of legal frameworks must be created for institutions to give more comfort to that. And I think it plays out. So the industry matures itself like naturally. And this is like a natural result of all those efforts which have been put to make the industry ready for institutional adoption.
How do you guys, because like one of the big challenges, I guess, as a prime broker, particularly in the crypto space, is like you're trying to kind of deal with these fragmented markets, right?
Yeah.
But we've got fragmented markets in terms of like access to collateral and liquidity across exchanges, but huge fragmentation in terms of the regulatory landscape of all the different exchanges and platforms. How do you guys sort of think about that and manage that? I mean, is that a big chunk of time and work for you guys to understand that landscape?
Yeah, absolutely, yes. I mean, the thing is that every exchange has its own regulatory KYC and compliance framework. I think this is actually something which I think it is a big area of improvement, and where we can add an extra layer of sophistication, meaning that like why can't we have just one single framework for compliance and KYC? And I think that it can be done in a way less manual way. But yeah, we do spend lots of time and effort on the legal side to be ready.
It's different jurisdictions, right? I mean, the UK, for example, talking about opening up crypto for retail, which wasn't happening, right? So, and these things are still changing, right? The rules keep changing. So it must be a full-time gig keeping up with all of that, right?
Yeah, I mean, absolutely. And as I said, that like the legal framework for that. So if you take a look at all the websites of big prime brokers in even centralized space, none of them have one legal entity, because it is impossible to use one legal entity to be complied with all of the exchanges they are onboarded with. So you really need to, and that's why a big part is getting licensed in different jurisdictions. And I think it is a good thing, because if you start thinking about licensing and getting licensed and getting like overseen by the regulators, it actually it puts some stop triggers and controls over you, which are good for the industry. So which were created specifically not to repeat the FTX thing. So it is a good thing that we are going through this. And this is the reason why institutions are more and more willing to work with crypto.
Yeah, it definitely feels like the game is changing very much from like a spec retail kind of asset to a much more mature asset. Like you mentioned funding rates on this latest move up that we've had, right? They barely budged, right? Which tells us it's not a futures-led move. It's not a spec-led move. It's an institutional money coming into spot markets, driving it higher, which should make people like us feel more confident that the move doesn't just mean revert straight back down, where all these guys get stopped out because it's fast money, right?
Yeah.
Same thing in the options market, right? Normally, when you had the old bull runs, breakouts, you'd have cool skew catching a bid, everyone piling into short-dated upside to try and play the momentum. You've had the opposite this time around. We've gone from 115K, where we were this time last week, to 125K. It's a decent rally, 8% in a straight line. I mean, and Vol was trading at 30-ish. Vol's barely budged, right? So Vol's kind of where it was. Call skew has not caught a bid. So if anything, puts us still trading above calls, which suggests that the institutional buyer who's piled into this is happy to own protection and put option structures in place to just keep riding the wave higher. And that really does make you feel much more confident in the rally, I'd say.
Yeah, and like you can really see, like as you mentioned, that it was like a BlackRock's one of the biggest inflows. So like now you can really see that the institutional flow drives the price movements of markets, which is actually the real attribute of a mature market, that institutions start to drive all those rallies and price impact. While as you said, exactly, that funding rates are like, they do not spike to 100% on Bitcoin as we've seen, like last year.
But because now, people look at Bitcoin at 125K and they're like, I'm not going to get rich quickly being long Bitcoin anymore, right? That ship has sailed many moons ago. So now,
is that why you think retail are not?
Yeah, retail aren't interested, right? I mean, if retail bother to learn how to use options, they can do very well, right? We've talked about altcoin-like returns. Like, I bought some call options last week when we started to break 118K, and they're like 4 or 5x in a week, basically, right? So, you're not going to go 4 or 5x on Bitcoin in a week, but if you stick a bit of premium into some calls as a technical breakout's happening, you can still do it, right?
How is your trading going around like this past week?
Yeah, it's
and like the
decent
vaults that you've got as well. And
from the vault side of things, really the main focus has been, the consistent one has been the hedged crypto, right? So that's just been trying to minimize drawdowns in sell-offs and participate in as much upside as possible in rallies, right? So probably since inception in January, Bitcoin's up about 30% since then, but it had a 25% drawdown at some point in March, April, right? So my hedged crypto strategy that is essentially trying to minimize that drawdown but participate in upside had a 7% drawdown at its worst when Bitcoin had a 25% drawdown. But up here at 30% up, it's up about 20%. So it's had 2/3 of the rally, but it had like 1/3 of the sell-off, basically, right?
Yeah,
or less.
Good,
so
good
it's kind of it's kind of doing what it's meant to. But yield strategies have been tough because just being short gamma on things like ETH has just been a disaster, right? So yield hasn't really worked. And then, like I say, but from time to time, I come in with some speculative, like some tactical trades, and like owning calls last week was a gimme, basically.
Yeah,
right?
and how are you positioned now? Like obviously we had a big move.
So I bought some futures on the breakout as well, just trailing stops on the futures. Took off my short dated calls because they're so short dated. So if you sit on short dated calls for too long, they just decay away to nothing, right? So you don't want to necessarily do that. So flipped out my Bitcoin calls. I had the 120K calls for end of this week. So flipped out of those. Still have take some Bitcoin futures off. It does look like 125 is a bit of a level and we do feel a little bit overbought, but just trailing stops on any residual futures longs that I've got, basically.
Yeah.
Yeah,
it's interesting. So I guess from what you're seeing as well, there's still no real signs of like, euphoria, top market type stuff. I mean, the only signs I see of that have actually been, when we're seeing like the Paul Tudor Jones and all these guys coming out like talking about blow off tops and all these big moves, which I kind of agree with, but it makes me nervous when I felt more comfortable the last few weeks when everyone's talking about it's the tops in, that's it, like 4-year cycles, this is normally where we top out. It felt a little bit more euphoric yesterday or so, or certainly like this week. But there's no sign of it there's no, like you say, in the funding or
if the core skew was catching a massive bid and stuff and it felt like it was over exhausted to the upside, then yes, maybe I'd be a bit more scared. But the fact that we've done this on the back of massive institutional inflows and put skew is firm. In fact, put skew's higher than it was last week in Bitcoin. That just tells me that this is a rally that's being protected, right? So it's going to be hard for this to just completely reverse that quickly, I think, right?
Yeah, I think that actually is, like euphoric, like the euphoria related to which we saw in 2017 and even a year ago. Like I really doubt that we would see that in the future. And it is actually like a good sign of maturing market, because I think that we are in a bull market now. It doesn't feel that wow as it used to be, but we can see plasma listing doing, I know, like X, whatever it is, huge inflow and activity in DeFi, etc. It just doesn't, like, people are expecting like X2 and Bitcoin in 1 month. You would not see that. But the great thing, the Bitcoin in like it is, I really doubt that Bitcoin will drop by X2 in 1 month too. So there is a price of mature markets, and the price is that you won't get rich in 1 day. But I think now, like, we are in a bull market. I would say in institutional bull market.
But what about, like, so on that point, clearly that's Bitcoin, right? But like, how far do you think we are in the adoption cycle for instos to get into the likes of ETH and Solana, right? Solana ETFs are on the verge of being approved, right? So is that going to bring in another 10 billion into Solana and take us to like 400? You know, where do you see we are in that kind of phase?
I would say definitely Solana earned its place in CME futures list. So it is a huge ecosystem, extremely well capitalized, like token and blockchain. Ethereum, of course, like we already see the Ethereum futures trading on CME and Ethereum ETFs. But I mean, like, we'll definitely see like increase in Solana, especially taking into account that we have Bitcoin treasuries, we have Bitcoin Ethereum debts, and we see Solana debts too. So I think that those are the signs that Solana is next in the queue to get some positive momentum, which recently.
But I'm kind of surprised it hasn't already started front running that. Like, I feel like the fact that it's not above 250 right here, right now, when we know that we're on the verge of the approval, and there's probably a load of money waiting to come and buy this in treasuries.
Yeah.
Why are we not above 250? It surprised me. And the vol's quite cheap. It's like the vol's at 70, 80 on Solana when it used to be at like 120, right?
I mean, like, that's, I would say, the whole thing was maybe it is like a some sort of like a trading like signal. We discussed this this podcast. Definitely not investment advice, but you know, like it same thing which happened to Bitcoin recently, that we saw a drop in interest rates. We'd not see the increase in Bitcoin at all
immediately,
but now we see the increase in Bitcoin, but we don't really know, like, you know, like, was it a lagged reaction to the drop in interest rates, or maybe there is some external factor which influences that. Maybe we would see some increase in Solana too soon because of these debts. But we see, you know, like Jump and Galaxy launching the Solana that I think it is like a very big market validation that these huge players are launching.
It does feel like a decent risk reward, that one, I have to say.
I think that's you know, I guess what I try and do, and when we come on here and through when I'm writing for London Crypto Clubs, connecting the dots of things, is to try and maintain like a framework. Like, you know, macro drives the core of that framework and the macro cycles, but then sort of looking at other sort of fundamental drivers. The funny thing is, though, is again, like if you're just a trader and you're trading in and out of this stuff, and, you know, then people come at me on Twitter and go, oh, you know, you've been bullish all the time, we just had this pullback, and it's like, well, you know, we know they will calm. You know, flows impact these things, and
yeah, exactly.
there's all these things, and it's
too many moving parts.
It's important to stand back and just kind of, again, just look at like the fundamentals of what's, you know, if you look, be it looking at network adoption, you know, be it looking at the fundamental macro backdrop, which is what we've been trying to say. You know, you've got this global rate cutting cycle that's ongoing and now kind of picking up pace. You've got global liquidity still sort of ripping higher. You know, and again, a lot of that private credit's like exploding as well, and sort of that's being created through the banks. You know, fiscal deficits exploded. All this stuff, you step back and you go, yeah, I would expect gold to be ripping. I'd expect Bitcoin to be ripping.
Yeah.
I'd expect NASDAQ to be ripping. when things don't happen immediately, people then start, stepping away from that, and then just,
it's the zooming out. People need to be better at zooming out.
Yeah, and patience, and like we all know, what is it? Aren't most of the moves of a year with the Bitcoin like over 10 days or something like that. So we actually spend most of the year chopping around, and then you get these big, periodic moves.
Yes,
if you're not in it on those 10 days, then you've basically made no money.
Yeah, which is like, and obviously like someone like yourselves, like superb at actually trading markets, and again you've got your hedges on around all this stuff so that you can monetize some of the volatility within it. And that's a great thing about options, to be able to do that.
Yeah, I mean, and the reality is, like, consistently hedging your portfolio isn't going to make you any extra money in a bull market.
Yeah,
the point of doing it is to reduce the drawdown in the bear market that eventually is going to show up when no one really expects it to, right?
Yeah.
So that's the point. Like, so it's not like I'm claiming to outperform the market in my hedge crypto strategy, not by any means.
No. Yeah.
But the purpose of doing that with a percentage of my crypto is so that if a turn comes out of the blue that I didn't expect, and that's the thing, people think hedging's about, this is what drives me bonkers about when people talk about hedging, and I see it on Twitter and I see it all over the place. It's like, if your hedges aren't working and if your hedges aren't making you money, that's a good thing, right?
Yeah.
The whole point of a hedge is it's against the long, and the long is supposed to make you more money than the hedge loses you. So if you hedge yourself so aggressively that you lose as much on the hedge as you make on the long, you didn't hedge, you just took your damn position off.
Yeah, you just paid transaction costs, right?
Yeah, you just flattened your book without realizing, right?
Yeah.
So a hedge has to be something that will lose you money, most likely. In fact, you pray it does, because your core position is the thing you actually want to own and the thing that you're in it for. And it's just that hedge is there to say that I'm willing to sacrifice some of the upside, because if something hits the fan that I don't see coming, and I wake up and we're down 20, 30%, I've been bailed out, basically, right? And that's the reason to have a hedge. And not everyone, cares to have that in their book and trade that way, right? People are just like, if it has a 30% drawdown, I don't care, I'll buy more, or I'll wait a few months and it'll recover, right?
Yeah.
And by all means, you trade like that. But it's like, if you do want to improve your Sharpe ratio, if you do want to improve your risk-adjusted return over a long period of time, which most asset managers and long-term professional investors do, then that's why hedging has a place in portfolios.
Yeah. And you think like some of these digital asset treasury companies and stuff would start to think about that more.
But you know what? I think they do think about it, but I think part of their issue is like they're so big and they custody their assets in places where it's not that obvious like how they should go about doing the hedging, right? Maybe they haven't been able to do it on Deribit, and that's where if you've got a few yards of crypto and you want to do a risk reversal in 2 yards, the only venue you can do that on is Deribit. And if you're not allowed to trade on Deribit, how are you going to do that? So I think as we open up to the world, and it becomes easier for people to trade on Deribit, or let's say trade in a way where the risk finds itself on Deribit, right? Where the liquidity actually sits in options, you're probably going to get a load of DATs coming in for those sort of trades. And that's probably why SKU's already slowly starting to sit in puts and stay there, even after we've just had a breakout.
Yeah, so I guess that is the thing, right? We are actually starting to see
I think we are, and it's just going to keep going more in that direction. There's like equity SKU has been in puts and all. Doesn't matter if the market goes up in a straight line like it has all year, pretty much since April. Equity SKU is always going to be for puts, right?
Yeah.
So I think at some point we're going to look at Bitcoin and be like, yeah, Bitcoin SKU always trades for puts for obvious reasons, right?
Yeah.
But anyway, I think that was a great conversation. We appreciate you coming on the show, man.
Yeah, interesting. Really interesting.
Thank you very much for a very fruitful conversation too.
Cool. All right, guys, we'll leave that with you. Remember to like and subscribe, and we'll catch you back again next week. Cheers.